see. Can you see it now?
Yes.
Perfect. Okay, I'll go over that again.
Yes.
Thank you. So the issue date was 1/1/2020. I just put 2020 because I like the years, not year one, etc. Face value of the bonds issued was 3.5. Stated rate was 1%. Market interest rate was 6%. The term is 8 years. And because we pay interest annually, the number of payments is 8, not 16. How do I calculate the annual interest payment?
Face value times stated rate.
Yes, so we're going to take 3.5 million, which is the face rate or face value of the bonds issued, times the stated interest rate of 1%, and that's it, because we're paying interest one time per year, so we don't have to multiply it by anything else. So the annual,
5,000.
the annual interest paid is going to be $35,000. For the issue price equals negative present value, open parentheses. What's the first number? What number do we put as the first number? And it tells us rate, number of periods, payment, future value.
Market rate.
Market rate. So because we're paying interest annually, the market rate is 1%. We don't have to do times 1/2.
6%.
I'm sorry, yes. Thank you. See, I'm making sure you're paying attention. Okay. The second date is the number of payments.
8.
And I included an extra row in there, 8. And then the third date, or sorry, the third number is the
The
amount that you're
35.
going to pay each period, which is the 35,000. So the interest paid annually in this case, comma, and then face value, the bonds issued, because that's what we have to pay back at maturity. So 2.413286 is my present value. Stop share. Okay. Do you see that? The correct screen now?
The Zoom screen?
Yes.
Yes.
Do you see the Zoom screen?
Yes.
Then you are not seeing the correct screen. Let's see. Share screen. Now do you see it?
Yeah.
Thank you. Okay, so issue price. Oops. 2,413,286. Does that calculation make sense?
Yeah.
So-
It makes sense. When you're practicing, practice this problem. Practice the other problem I gave you, which was P9 59B, because both of those are annual interest payments, not semi-annual, and that's going to help you practice. I know the calculations. For the next calculation, before we get started on the table, the amortization table. So this would be the answer for A that you would include. What is the maturity value of the bonds? Do we even need to calculate anything for B? Is B given to you? How much do we have to pay back at maturity?
Do you pay back the face value? Which is
Correct. We always pay back the face value. See something? So 3.5 million is your answer for part B. Face value of the bonds. For part C, what is the annual cash interest payment on the bonds? We already calculated that, and it was face value, 3.5 million, times 1% or 0.01.
35,000.
The 1%, all the interest rates you're given are always annual unless stated otherwise. So every year you're paying $35,000 in interest. And for part D, we're going to figure that one out right now. Part D and then 2.
Yeah, I have a question before we move on.
Yes.
Can just like real quick, how do we get the issue price again? Like I was
Uh,
tracking, but I just wanted to make sure I have it.
Okay. Do you want me to write it out in words?
Yeah, sure. Or just write it out in words.
Okay. So I'll just put it down here for E, for A. Equals negative PV, which is present value, open parentheses. The first number is going to be my market interest rate, and it's not multiplied times 1/2 because we pay out annual interest. So 0.01. If you're using Excel, you have to use the 0.01, convert that percent to a decimal. And if you're coming up with the wrong number, always check those conversions first. Check every single number that you're using in the calculation for your present value. So the market interest rate, sorry, it's not 0.1. For whatever reason, my brain keeps saying it's 0.1. The market interest rate at the date of issuance is 0.6 or 6%, 0.06. The second number that you're using is the term, in this case, or the number of payments. And it's 8-year term, so 8 years times 1 payment a year, 8. The third number that you're using is the amount of annual interest, and I'm going to erase this. The annual interest paid, or the amount paid each payment date. And the last number is always the face value of the bonds issued, 3.5 million. Double check the number of zeros that you're including in it, because I've seen that as an incorrect number in the calculation. Check every single number that you're using if you're coming up with the wrong one. If you forget the negative, it's going to show up as a positive. It'll show up as a negative number, and you just remove that.
Thank you very much.
Yeah, no problem. In your homework, some of the bonds that they were issuing had, I believe they gave you 2 different issue amounts. They gave you 2 different numbers that could have been the face value. That was probably part of the confusion, but it is not going to be like that on your test problem. Okay. The table. What's the first date that we include? Always. What is the first date that you use in the table?
The
Issue
issue
date.
date.
The issue date, yeah. So these bonds were issued on January 1st, and they're using year one, so I'm just going to put it because I believe that's how they're going to want you to put the answer. So this date is always the issue date. On the issue date, do we pay any interest? Never. So your answer is 0. I'm not sure if they have you leave it blank or if you put 0, but on my answer key, it's showing up as a blank number. For interest expense, so that's why I want you to practice them to make sure. Interest expense, if we don't have any interest that we're paying, we're not incurring any interest on the issue date, so it's also 0 or blank. If we don't incur interest or pay interest, we have nothing to amortize, so that's 0. And how do I calculate my discount balance? What's the first thing I need to do?
Face value minus issue price.
Correct. So face value of the bonds issued, which was 3.5 million, compared to the issue price, which we calculated, 2,413,286. So the discount balance, discount on bonds payable, how much less cash we received than what we're going to have to pay back at maturity. It's a substantial discount because we're paying 1% versus the market paying 6%. So 5% annually is being paid out lower than what similar bonds were paying. And don't be surprised if you have a substantial one on the test. How much is the discount?
1,086,086 and 714.
Yeah, 1,086,714. Okay. You're lucky it's not having you do journal entries. You're probably happy about that. If you're doing this in class, you would be doing journal entries too. For the bond carrying value, how do I figure out the bond carrying value? Or what is the bond carrying value initially? Always.
Issued price.
Issue price, yep. 2,413,286. Question, is there a way to kind of double check these two rows? Rows D and E.
Add them together and see if it's equals.
Correct. In order to, for bonds issued at a discount, if you want to double check the numbers that you're including, when you add these two amounts together in every single row as you're going down, they will always equal face value. So the discount balance plus the bond carrying value will always equal face value. Questions on that first row, or do you want time to catch up?
I feel pretty comfortable.
You feel comfortable?
That makes sense.
Okay, good. So this one is having you go through the term. So you have 8 years. So we're just going to include all of them right now. When do these bonds pay interest? On what date?
31st of December.
Correct. The end of their year, which is December 31st. So the first payment date is going to be December 31st, year 1. The second payment date will be December 31st, year 2. Third will be December 31st, year 3, etc. The nice thing about this problem is that you're going to see what happens to the discount balance. You're going to see what the bond carrying value will be at the end. So you can kind of know what your answers need to be at the very end, right? Yes. And if it doesn't come out to the correct answers down here, then you know you made a mistake somewhere above. At maturity, what does the discount balance need to equal?
Zero.
0, yep. Because you're going to fully amortize that bond to 0. The bond carrying value will equal what at maturity? At the end of year 8, we have to pay back what amount?
Face value.
Face value. So at maturity, the bond carrying value will equal 3.5 million. Face value. So this is information that's going to be useful for you just to double check your numbers and your calculations. And I'm just going to include 2 calculations below for columns A and then B. So column A, we have already calculated it, but I'll put it in words. Column A is our interest payment, annual interest paid. And to calculate it, we took face value, the bonds issued, times the stated interest rate. So 3.5 million. These bonds pay out interest at 1% per year. So $35,000 was our annual interest payment for column A. And just include it here, all the way down, correct?
Correct.
Every year you're going to pay out $35,000 in interest. The amortization schedule is showing us the payment dates. And I'm sure you guys are happy that this is not paying out semi-annual interest, or you would have 16 different payment dates to do. For column B, this is our annual interest expense. And it's going to be the preceding bond carrying value, which is going to be increasing slowly over time, times a market interest rate, the date of issuance. So this number is going to be a different calculation each date, correct?
Yep.
So at December 31st, year one, your interest expense is going to be based on what preceding bond carrying value? What's the beginning bond carrying value for year one?
Issue price.
The issue price, correct.
6%.
2,413,286 times the market interest rate, which was 6% at the date of issuance. So at December 31st, year one, how much in interest expense will I recognize? It's a huge amount because that discount is massive. So the amount of amortization we're going to take is substantial.
144,797.
Yes, 144,797. Don't be surprised if there's a huge difference between the amount of interest that we pay and the interest that we're expensing. Look at those interest rates, they're substantially different. So for the discount amortization, it's the difference between how much in interest expense we've incurred and how much in interest we're paying out on December 31st. So how much do we amortize the discount on this date?
109,797.
Correct, 109,797. And what is going to happen to my bond discount? It's slowly going to be reduced, right? So 1,086,714 with my initial discount balance. I'm going to subtract 109,797 and my new discount balance becomes 976,917. The bond carrying value at the same time is slowly increasing because at face value, or I'm sorry, at maturity, it's going to equal face value. So 2,413,286 is my beginning bond carrying value for the period, plus 109,797, the amount of amortization, that bond discount that I took. So at the end of year one, 2,523,83 will be my carrying value of the bonds. And that is also the answer for Part D. Because it asked us, what is the bond carrying amount of the bonds at December 31st, year one? 2,523,83. And the next question for part two, it's saying prepare an amortization table. Obviously, we're doing that. How much is Thornton's interest expense on the bonds for the year ended December 31st, year four? So we have a few more periods to go before we get to that question. Do you guys want to do the next few years by yourself just to practice?
Sure.
Okay, I'm going to pause the recording. Okay, make sure that you use Excel because of those rounding differences that you're going to see come up, and specifically it comes up in it impacts year four, correct?
Yeah.
Okay. And it has to do with those decimals that I showed you. So it's right here. Okay, because it's the sum of all those decimals, and at year 4 is when those decimals go over $1 and it's impacting what you're going to show. So in your calculations on the spreadsheet, it's going to show the same numbers as what you have right here. You would have caught it in the last year, correct? This is when you caught it.
Yeah. Well, yeah, that would be where we found it. I just found it because you were putting the answers up too.
Yeah.
So I was like, okay, that's one off.
And it's one off because of those decimals, and that's all.
So if we don't use the table in our test, then we're gonna get it wrong.
Correct. Because it does tell you to use Excel to do the calculation too. Now, I'm going to give you this to practice with and have, but you can still have user error in the calculations over here. So this is not saying that you're going to always calculate the issue price correctly. You're always going to calculate the annual interest paid correctly. Does that make sense?
Yes.
Because I had somebody question and say that they had it, but user error does happen. I make errors. It's part of learning, part of learning, and you just have to double check everything. So if I've hard coded any numbers in here, then sometimes they come out incorrectly. So double check every calculation in here to make sure that it does calculate and compute correctly. Do you want me to write these all out for you, or do you have them? Do you want me to go back to the notebook?
Yeah.
Okay. Other than that one little rounding issue, how did you do? Good?
Yeah, I did good. I mean, I stopped at like year 6 because I was in the middle, and then I like asked you about that. So I didn't completely finish.
That's okay. As long as you got through, you know that you're doing basically the same thing over and over again.
Yeah.
Okay. Okay, so I put your 5. And if you guys put the 6 right here, obviously your interest expense calculation might be slightly off going forward because you're 1 off. So for this next one, for year 5, I put in the interest expense, the amortization, discount balance, and then the bond carrying value became $3,032,223. So to calculate the next year's interest expense, so years 6, $3,023,223 times 6%, and you calculated $181,933. The amortization for that year would be $146,933. The discount balance is shrinking, so 467,777 minus 146,933 becomes 320,844. I'm just going to move this over because I have slightly off. And then my new bond carrying value at the end of year 6 becomes $3,179,156. So far, so good. For the year 7 interest expense, you take $3,179,156 times 6%, and you calculate interest expense of $190,749. And the amortization for that period was 155, 749. Discount balance shrunk again. Now it's 165, 94. And my new bond carrying value is inching towards face value. So it's 3,334,906. In the last year, we're going to take 3,334,906 times 6% to calculate interest expense. Interest expense in the final year is the highest amount that we're going to record, 200,094. So look, it's slowly increasing in interest expense that we're recording because that bond carrying value is slowly increasing. The amount of amortization that we take in that final year is the difference between the 200,094 and 35,000. So it's the highest amount, 165,094, exactly equal to what our discount balance equaled in the period before, in the year before. So 165,094 minus the amortization, 165,094. 0 is my new discount balance because I've reached maturity. And the bonds at maturity equal face value. Questions? Oops, I am not moving, it's just moving itself. I'll let you finish writing this out, but try to answer 2 and 3. So 2 is how much is Thorson's interest expense on the bonds for the year ended December 31st, year 4? And then 3 is show how much Thorson would report these bonds and notes at December 31st, year 4. And there is an error. What's the interest expense that we're going to show in year 4?
$165,770.
Correct. 165,770. And I am so sorry there is an error and I see it, and I will have to go back and auto correct. No, year 7 is not 165. 095. It's 094. For this portion, so it's asking you in the footnotes what you're going to have. And this is where that note comes into play. So you're looking at the current liabilities section. first, and the current liabilities is going to be the current portion or current installment of notes payable. And if you look over here, it says that notes payable is 6% payable in $45,000 annual installments starting in year 5. And the whole balance of it is $270,000, the principal balance of the note. So how much is going to be paid in principal in year 5? Because this is the amount that's the current portion of notes payable. $45,000 is paid out in year 5. So that is my current installment of notes payable. They give you the current installment. For long-term, liabilities, you have 2. The note, and then you also have the bonds. So for my long-term liabilities, bonds payable is what you're going to start with. Face value of the bonds payable is 3.5 million. Less the discount on bonds payable, and this is where the error is, or the first part of the error. What should this amount be? What should the discount on bonds payable be at 12/31 year 4?
$130,770.
No, it should be here. Not the amortization, but the discount balance.
Oh, gotcha.
So this should be 606,393. And I'm going to tell you that they're looking for not 606,393. The correct answer that's showing up, which is incorrect, is 606,394. So you may have had this error in your homework problem. And I have to go in and auto-correct the grade. And I'll have to auto-correct the grade for this problem. But if you put the correct answer, 606,393, if you put the correct amount that was recorded in your amortization schedule, I will give you the correct answer. I will give you credit for it after the fact.
Wait, so isn't that what we were having when we caught the issue earlier because of the Excel?
Yep, that was the rounding error.
Gotcha. So the correct answer is 606,393?
The correct answer is 606,393, yes. They have it incorrect. It's 606,394.
Oh, gotcha. Okay.
Yeah. It's a rounding difference. That's all it is. So if you put 606,393, it will be marked wrong by the system. I will go in and auto correct it for you to the correct grade. For the next part, which means that if you have that number wrong, marked wrong, then it's also going to mark you incorrect for this next amount, which is, and they're not going to put it there, sorry. They want it right next to it. The carrying value of the bonds, which is 3.5 million minus the 606,393. The true carrying value of the bond should be 2,893,607. And they're going to show that is an incorrect number. What they're going to show is the correct number, which is wrong, is 2893606. Does that make sense?
Yes.
Okay. For the next one, which is the last thing, it's notes payable. And notes payable has 270 as the total note, but you carved out part of that because it's going to be paid out next year, 45,000. So you're subtracting 45,000. And the long-term portion of the note is 225. So I'm going to put it under this one too, because this is going to, the last line would also be incorrect. And this would be total long-term liabilities. And it's the sum of these two numbers. So 2893607 plus 225, you should come up with 3,118,607. But what they're going to show is the correct answer is not that. The correct answer they're looking for is 3,118,606. Just this over. And they're also going to look for total liabilities, which is current liabilities plus long-term liabilities. So this is also going to be slightly off. 3,163,607 is the correct answer. But they're showing that the correct answer is 3,163,606.
I have a really quick question.
Yes.
The total liabilities, where'd you get 270,000?
270 is over here. It's given. Notes payable, 6% payable, and $45,000 annual installments during the year 5, 270,000.
Okay, got it.
Yeah.
I also have a question. So you said that those numbers, the 606,394 is incorrect. That's what I got. And then same with the 2893606.
Okay.
That's what I
So
got when I did
that's
it.
what you got when you did it on paper, correct?
Okay, yeah.
Yeah. So on paper, you did it like that because of the rounding, because you'd been rounding all along,
Mhm.
right? But when you look in Excel, it takes into considerations those rounded numbers and it changes.
Okay, so that's incorrect to the system.
Correct.
Okay.
This Excel is showing you what the correct answers would be. The actual. But when you're doing it by paper, because you're rounding the whole way, you're rounding it off, you're not writing out the decimals, that's where you're losing that.
Okay.
So basically my guess is they had one person programming for the Excel portion, another person programming for this portion, and they weren't looking at how they did it. So it is showing
Okay.
correctly. I'm sorry. I'm going to have to report a content issue on this one, but it needs to be corrected. So I apologize. Do you guys want to take 5 minutes?
Yeah.
Okay. I'll leave this up here so you can see it, but I'm going to pause the recording. And what I said to Servette goes for any of you. If you guys have any questions on any of the problems, just email me and I can help you out. So for the last problem on the test, this is from chapter 8. So you have 2 problems from chapter 8, the notes payable that we went over last class, and then this problem, which is showing how you record liabilities, current liabilities in the balance sheet. So they give you a list of liabilities. And I realized that something is wrong. Never mind. I'm so sorry. I think in the study guide that I gave you, there's extra information that you don't need, and I forgot to erase. So I apologize for that. I just saw my error. But all you have to do in this problem is recreate or create the current liability portion of the balance sheet. So they give you a list of information. That's where we're going to start because you want to eliminate the information that's not a liability before you even start writing it out. Now, I'm going to write it in the order that the textbook shows the answer. I don't necessarily agree that this is the correct order, and I don't know if they're going to dock you points if you don't put it in this order, so pay attention to the order that I'm writing it. First things first, so accrued warranties payable. Is that a liability? Warranties payable?
Yes.
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 Yes. So we know that we're going to use that. I'm just going to put a little check mark next to it. For the next one, notes payable. It is a liability. It's payable.
Yes.
Unearned service revenue.
Liability.
Liability. Accounts payable.
Liability.
Liability. Most of them will be liabilities, but there are a few. Employee income tax payable.
Liability.
Liability, because you know that payable word. Accounts receivable.
That's
What is it?
an asset, right?
That's an asset.
Correct. It's an asset, so it's not going to be included. Just cross it out. Interest payable, liability. Bonds payable, liability. And what do we know about bonds payable? It's typically long-term, right? So most of it is long-term, but part of it will be current in this one. Accumulated depreciation is a contra asset. So we remove it. Treasury stock is a stockholder's equity account. We're going to talk about that in chapter 10, next class. Salaries payable,
Liability.
liability. Notes payable, liability. Sales tax payable, liability. And then FICA tax payable. I think, yeah, sorry, I cut off the wording. It is payable. I just wrote pay. So 3 of those items are eliminated. That helps. Before you start writing out the balance sheet, look at the additional information because bonds payable is typically long-term, but part of it might come due. Some of the principal might be owed within 1 year, the balance sheet date, so that becomes current. And then other things might also have implications of the amounts. If it doesn't tell you anything about the item here at the bottom, or if they don't give you any additional information about an item listed, it's assumed that the entire amount is current. Does that make sense?
Yes.
Okay. So Filbert Corporation provides multi-year warranties with its products. So these people can return their products for several years, not just for 1 year. Half of the accrued warranty liability relates to warranty liabilities that will be paid in 2019. So half of those warranties will be paid out in 2019, and half of those warranties won't be paid out in the coming year. So that 58,000, are we going to record all of it as current at December 31st, 2018? If 50% is going to be paid out after December 31st, 2019, what does that mean?
We only have to account for half of it.
Correct. We only have to account for half of it because we're focusing on current liabilities only. So we're going to take this times 50% to get the actual amount that we're going to record in the current liabilities section of the balance sheet. So what is 50% of 58,000?
$29,000.
29,000. So remember that current liabilities are amounts that are owed within 1 year of the balance sheet date. Anything that's owed after that 1 year period is a long-term liability. So this is the current portion. So it says, while the other half relates to warranties to be paid in 2020. So I don't care about the 58, right? I care about the 29. The unearned service revenue pertains to service contract that will be performed during 2019. So unearned service revenue, 48,000, is that 100% going to be included?
No, because they said that it's going to be performed during 2019.
Is that the coming year?
Yes.
So it 100% is. So they're going to earn 100% during the coming year. So it's going to be current.
Got it.
Yeah, that one was kind of tricky. For the last portion, $100,000 of the 8% bonds payable due December 31st, 2023 is due on December 31st, 2019. So here's my bonds payable that are due on December 31st, 2023. 500,000 is not going to be the amount that we're going to use, but how much is current?
8,000.
So 8% is the notes interest, or the bonds interest, sorry. What amount is current?
8,000.
No, 8,000 isn't right.
Is it 8% of the 100,000 or 500,000?
No. So 8% is the interest rate. I'm not asking about interest. I'm asking about the principal due, how much is going to be paid out next year. So of the face value of those bonds that we issued, how much of those bonds are going to mature within 1 year of December 31st, 2018? 100,000. So 100,000 is what we're going to use. 400,000 of that bonds would be considered long-term, not used.
Got it.
Yeah. So it's not asking me an interest that's going to be paid out. It's asking me specifically the principal that's going to be paid out, because the interest payable is already calculated for us. We don't have to calculate it. It's assumed that everything else is current. So what we just had to calculate, you can assume that you're going to have to do similar calculations on your test. So I don't agree with the order that they're giving it to you in, but I'm going to write it in the order that they are giving it to you and having you enter it on the test, because I don't want you to get marked down because I gave you a different order. Does that make sense? But technically you are supposed to write it in liquidity order, so when it's going to be paid out. Under current liabilities, you always start with accounts payable. That's always listed first. So you have current liabilities. This is in the balance sheet. Accounts payable is going to be the first one. So accounts payable, and I'm going to go over, and as I use it, I'll mark it off. So accounts payable, the balance is 225, and that's what you're going to put. It was given. They list out the two notes next. And you pay attention here. That first note is due April 30th, 2019, so 5 months out, versus the second note, which is due at the end of 2019, so a year out. They're both still current, but this one is paid out first, so it's going to be listed first. So 4% notes payable due 4/30/19, and the principal of that note is 150,000. Exactly what was given. And then the second note is 5% notes payable due December 31st, 2019. 200,000 is the value. So 5% notes payable due 12/31/19. After this one, the wording isn't exactly given to you. So it's related to the bonds payable. So you're going to write current portion of long-term bonds payable. So remember, we kind of went over that the beginning of chapter 8. The current portion of long-term debt is what we usually call it. They're calling it current portion of long-term bonds payable. And that means that how much of the principal is going to be paid out on those bonds during the coming year. And we know that it's 100,000. So we carve it out of that. And I'll put a little asterisk next to this one because you did have to calculate it. The next one that they're going to list out is salaries payable. Think about salaries payable. You're going to pay it within the next month. Salaries payable, and it's going to be the entire amount given to you, which is $84,000. After salaries payable, we're going to put FICA taxes payable. Okay, because they're going to remit those taxes on your behalf to the government. So FICA taxes payable, and they're going to do it when they pay you. Same period, they're legally obligated to do so. 7,000. After the FICA taxes payable, it's another one that relates to the payroll employee income tax payable. 27,000. So if you've ever looked at your pay stub, all of those taxes that they're withholding on your behalf is where these payables are coming from. And when they pay you is the date that they send those taxes off on your behalf to the government. The next one is going to be interest payable. 29,000. They don't tell us the dates that they're paying interest, so we don't really know when it's going to be paid. So it makes sense that it's after the salaries, probably paid out after the salaries. And sales tax payable is listed next. 67,000 was given. The next one is unearned service revenue, 48,000. All of it's earned next year, so we include the entire amount. Unearned service revenue. So everything that we've listed so far has been the known payables. So what we know exactly how much we're going to have to pay out. The last thing that we're going to record and write out is what we don't know. It's the estimated payable, which is our accrued warranties payable. And it's not the 58,000, it's the 29,000, half of that estimated warranties payable. So accrued warranties or warranty payable, 29,000. And I'll put a little asterisk. Most of the numbers are given to you, correct? Only two of the numbers did you have to calculate or record differently? And I'll just highlight it, the 100,000 related to the bonds payable, and then the accrued warranties payable. The last line is just total current liabilities. And what do I do to figure out this number? Add up all of these liabilities that you've listed above. So take a minute and do that. What'd you calculate?
966,000.
Correct. 966,000 is going to be your total current liabilities, and that's all for this problem.
I have a quick question.
Yes.
Are there any like other practice problems to go along with this one?
Yeah, so the other practice problem that's similar is problem 850B. I'll write it down here. And if you look up, so it would be kind of hard for this one because it is learning objectives 1, 2, 3, and 4, which I believe is all of the learning objectives from chapter 8. But this one's going to be similar. Problem 850B will be similar.
And then on the same thing for the last problem we did you tell us any other similar problems? I might have just not seen.
I think I did, but I can repeat it. It's problem 959B is a similar problem to what we did for the last problem.
Awesome.
Yes. So for this problem, it does say at the bottom, students may list in a different order, but I would list it in the order that I just gave you because I'm not positive if it will mark you off. Remember, it's the system. The system's not an accountant. It's an IT person that created it. So they don't always go by what's correct, in my opinion. Does that make
Is the
sense?
study guide posted accurate?
The
this
study
one?
guide posted is accurate. The one that's
Because it has 7 problems on it.
no. Sorry. Okay. Problem that your study guide that you're looking at is from the old one. My on.
Oh, okay.
Yes. So in
Okay, that's why I'm
module,
confused.
sorry, module 3, go to the exam page and you will see this study guide. And
Okay.
can you email me and tell me where you found that one and I will delete it out?
Well, I found it in the Zoom link from last class.
No, I gave you the wrong one. I'm sorry. I attached the
It's
wrong
okay.
one. I will attach the correct one right now. I apologize.
So like in our assignments or where? On Canvas?
Yeah, in Canvas and modules,
Okay.
module 3,
Module 3.
go to the exam page.
Okay. Exam
And-
study guide.
No, the exam. You should see it.
Okay.
It's written out in there.
Oh, and you have this summary, so we could just like copy and paste this into like
Word.
Google
Yeah.
Doc or something. Okay.
Correct.
Okay. So
Sorry.
what problem is this?
This is problem number 4.
4? 4. Okay, because I was looking at the other one. That makes more sense. I
I'm
was
so
like,
sorry.
what's happening? It's okay.
Yeah, this one is not like any, I don't usually do this assignment in class 1.
Okay, thank you.
Wait 1 second. I'm going to post the correct one right now. I am so sorry. I did not save it. That's why. I'll post it in the announcement today.
Okay, thank you.
Yeah, I'm sorry I attached the wrong one.
No, it's
You
fine.
guys-
I thought I would ask.
Thank you. Do you guys have any questions on either of those 2 problems? The test is due this Saturday. If you need extra time, let me know. You have 2 attempts to it. You have all the parameters listed out in that exam page. Practice, you know that. We'll start chapter 10 on Wednesday. I'm not going to even start it today. But chapter 10, if you can try to do the pre-assignment before Wednesday, I'd appreciate that. If you don't want to do it until after you take the exam, I also understand that. So that's fine too. Practice.
I didn't see.
What was that?
I didn't see chapter 11.
Okay,
Like
so
last time.
chapter 11 we skip. So for this class is hard enough as is. And I don't see a purpose in teaching cash flow in this class. I teach it in managerial accounting. So it's in our student learning outcomes or our course learning objectives or outcomes for managerial accounting, which is why I teach cash flow in the other class.
So how many chapters do we have left? We have chapter 10.
10 and 12.
Oh,
So
okay.
we skip 11 and we do 12. Chapter 11 we'll learn in managerial.
Gotcha. So we're coming up to the last few chapters, huh?
Yeah, you guys only have 2 more chapters, so you're doing a good job so far. Just keep plugging away at the homeworks, improve your scores. I'm keeping track of where you guys are at point wise. So after this next exam, I can run where you would be at this point in time point wise compared to the total points in the class. So you should have seen in Canvas that I gave each of you 100 points for the financial statement project because I'm not going to have you do it.
Oh,
Did it
awesome.
3 times. I don't know if anyone else saw that, but
Oh
there
my
was like, it said
Okay.
FS and then it
I
said
know
financial
why.
statement and then financial statement project.
Okay, I know why, because first I was having some technical issues because every time that I went to save it in my accounting lab, it zeroed it out. And so I had to create it again. I will delete the extra 2.
Okay.
So right now your grade looks inflated.
Yeah, I was
It's
gonna
200
say, I'm
points.
like, she gave us a lot of extra points.
Yeah,
And then
yeah.
also with the exams, it's like, I don't know, it doesn't really matter, but you have some of them titled as exams spelled out with
Okay.
like numbers, and then it's also EX with different numbers.
Yeah, and some of them are just showing as zeros. So this is also
Okay.
part of what I was having issues with is because when I went to carry it over from my accounting lab, for whatever reason, it wasn't carrying over. And so I selected all of those. And in my accounting lab, if I don't change the name of the exam, when I manually input them, it makes me go through each student individually instead of entering all of my grades individually or all at once.
Okay.
So when you take classes, the on-campus exams, and that's what those are dragged forward from previous years, that's what happened. So I'll delete all of
Okay.
those. Sorry.
Okay. No, it's fine. I was confused on like
I
why
know.
there were so many different things. Yeah.
And thank you for telling me about the financial statement one because I can correct that really fast.
Yeah. And then I still can't see my results from my test, the last test.
Exam 3 or exam 2?
2.
Okay. You should be able
Because I
to.
only used one of my tries, and
Okay.
it still says like take again or something
Okay.
like that.
I will go back and make sure the settings are
Okay.
correct on that. But you should be able to. If not, then I can go through it. I'll fix it.
Okay, thank you.
Yeah. Any other questions?
Oh yeah, you cut out for me when you were saying that you would prefer something turned in by Wednesday. I don't know what you were talking about.
Oh, yeah. So the exam, sorry, not exam. Chapter 10, we're going to start on Wednesday.
Okay.
So if you can try to do the chapter 10 pre-assignment before Wednesday, preferably, but I understand if it would confuse you and you want to just study for the exam, just do it after you take the exam.
Yeah, I've always been waiting. I've skipped like a lecture too. I'm like, I can't think of anything. I can't learn anything new right now. I need to like dive into this.
I get it, but I have to,
Yeah.
just because of the schedule, I have to start chapter 10 before you guys
Yeah,
take it.
no, that makes sense.
Yeah, sorry.
No, it's fine.
Okay, I'm gonna pause the recording.